Welcome back to the deep dive. You've handed us a stack of sources that, I have to say, paint a fascinating picture of the market right now.
Fascinating is one word for it.
It feels like it's like we're reaching for this incredible peak of tech optimism with one hand, while with the other, we're sort of hanging on the edge of a structural political cliff.
That's a perfect way to put it, because when you just glance at the daily pulse, you know, U.S. indices might look stable, maybe even a little bit higher.
Suggesting everything's fine.
Exactly. But then you dig into the hedging signals, and the story just completely changes. You've got oil weakness, which points to slowing demand, but at the same time, you see real strength in gold.
The classic flight to safety.
The classic flight to safety. And that divergence, that tells you everything. It shows investors are actively, maybe even nervously, repositioning for some major political and policy uncertainty ahead.
Right. So this isn't just the usual jitters about the next jobs report. The real tension we have to get into today is how markets are trying to balance this immediate softening economic data. And we're talking about real pressure points like housing against this rising risk that's entirely political, the independence of the Federal Reserve.
And that's the key. Our sources make it really clear this political pressure isn't just, fleeting headline noise anymore. It's actually becoming a real structural concern.
One that changes the math.
It fundamentally changes how investors have to calculate long-term risk and, crucially, inflation expectations.
Okay, let's unpack all of this. This deep dive is our shortcut to understanding the three biggest variables shaking up investor confidence right now. First, that long-term threat from the Fed's political anchors. Second, the immediate fragility of the consumer, which we can see in housing and retail. And finally, the huge high-stakes bet the entire market is placing on the AI economy, all through companies like NVIDIA. That's our mission.
And we absolutely have to start with the Fed. It's the one variable that could reshape everything, all future inflation and interest rate outlooks.
So why now? Why is this political pressure suddenly being called a real market risk instead of just, media chatter?
Because the evidence of active influence is just so specific now. The sources are detailing explicit attempts, not just talk, but actual moves, to, for example, remove figures like Governor Lisa Cook.
Wow.
And at the same time, the strategic installation of political operatives like advisor Stephen Mirren right onto the FOMC.
So it's a two-pronged effort.
It is. And you layer on top of that these repeated, very public calls for much lower interest rates, even when the inflation signals are still flashing amber.
If we connect those dots, it points to a pretty clear policy bias trying to take hold.
It's a bias that explicitly favors short-term economic growth
over the Fed's traditional and often painful job of controlling long-term inflation.
Exactly. The mission becomes growth now, even if it means sacrificing stability later.
And this is where the market dynamic gets so tricky, right? Because it sort of flips on itself. In the very short term, this expectation of easier money, it can actually look pretty good for risk assets.
Oh, it can be very supportive. Lower rates, easier credit, they boost corporate valuations, stocks like that.
But that's the sugar rush.
That is the sugar rush. The moment the market truly believes this is a structural long-term change, that the Fed's anchor on inflation is weaker, the whole thing reverses.
This is the aha.
This is it. Long-term inflation expectations start to drift up. And when that happens, long-term yields have to rise because investors start demanding much higher compensation.
A political risk premium.
A political risk premium. They need to be paid for holding debt that's anchored by a central bank that's suddenly seen as less reliable.
So this is a really perverse situation where the good news, the lower rates, temporary, but the bad news, the long-term inflation, is sticky. How long can that short-term window even last?
That's the billion-dollar question. But history gives us a pretty strong hint. The sources point to a Bloomberg economic scenario that links this kind of political influence to what happened in the early 1970s.
Right.
You had this pre-election boom, all fueled by easy policy, which was then immediately followed by years of just devastating runaway inflation.
And that inflation required it was a monumental and deeply painful correction. We're talking about the Volcker reset. For anyone who might not remember, can you just quickly break down what made that so painful?
Absolutely. The Volcker reset wasn't a tweak. It was a brutal slam on the brakes. To finally kill the inflation of the 70s, Fed Chair Paul Volcker had to push interest rates into the double digits.
He went to nearly 20%.
Nearly 20%. And that triggered two back-to-back severe recessions. It was necessary to restore the Fed's credibility, but the short-term cost was just massive unemployment and economic pain.
Okay, so compare that history to today. The stakes feel much, much higher.
Oh, significantly higher. Today, we have exponentially higher global debt levels. Capital moves so much faster around the world.
So a shock would be amplified.
A Volcker-style shock today would be sharper and potentially way more destabilizing. And even more critically, a perceived loss of Fed independence. It wouldn't just raise our borrowing costs here at home. It actually poses a risk to the dollar's global premium.
Okay, we can't just rush past that point. That's a profound implication. The dollar's status as the world's reserve currency. We all just take it for granted.
We do.
If the market starts to believe that the U.S. is prioritizing short-term politics over long-term stability, how does that vulnerability actually show up?
It challenges the very foundation of the dollar's premium, which is trust. Trust in its stability and the institutions behind it. If inflation is allowed to run hotter because of a political mandate, other countries, foreign investors, they will just logically start looking for more stable alternatives.
And that loss of trust would raise borrowing costs for the U.S. government.
For the government, for all U.S. corporations, it effectively exports that political risk premium to the entire world.
So the key signal to watch isn't whether the next jobs report is strong or weak. It's whether long-term yields start moving up, not because the economy is booming, but because they're quietly embedding this new political risk.
That is the signal. A demand for more compensation for a potentially reckless policy path.
Okay, so that's the high-altitude threat. Now let's bring it right down to the ground and see how that uncertainty is already showing up, starting with housing. This is where we see the immediate fragility of the consumer.
And the housing data is giving us really explicit, granular signs of strain. It shows you just how sensitive the current market is to rates. Mortgage applications fell 5.2% last week alone.
That's not a blip.
That's not a blip. That's buyers just backing away. It happened as the average 30-year fixed rate rose for a third straight week to hit 6.37%.
And when you break it down, the rate sensitivity is just screaming at you.
Yeah.
Refinancings, which are always the most elastic part of the market, they just collapsed by 7%.
That whole business is gone.
Gone. But even more telling, new purchase applications, people actually trying to buy a home, dropped 2%.
We're seeing a significant rate shock, especially for those marginal buyers. I mean, if your potential monthly payment jumps by, say, $200 because the rate moved just a little bit.
Yeah, from 6.1 to 6.37.
That's enough to push your debt-to-income ratio too high. You're forced to the sidelines. And we see this confirmed in the microsignals. The average loan sizes, they slipped to their lowest level since August.
Which tells me the only people left transacting are either wealthy cash buyers or they're being forced to look at much, much cheaper properties just to make the monthly payment work.
Precisely. The result is this rapid tilt in activity toward the lower-priced end of the market. And that moderation at the higher end means home price gains are extremely likely to slow down.
Or even decline.
Which creates major headwinds for every related sector, from building materials to home appliances.
And that weak consumer story flows right into retail distress. Target's recent numbers highlighted this perfectly.
Oh, Target is facing a severely soft consumer backdrop. Their Q3 revenues fell 1.5%, same-store sales dropped 3.8%.
And the traffic.
And the most concerning part, shopper traffic actually turned negative. When fewer people are even walking in the door, you have a real problem.
So the core issue isn't really whether Target stocked the right stuff. It's that this value-seeking behavior is now dominant everywhere. Consumers are fiercely trading down.
They are. They're pulling their discretionary spending away from general retailers and pushing it toward discounters. The wallet is just stretched thin.
And Target's response is to get technical.
Very technical. They're rolling out an integration with a shopping assistant inside ChatGPT for things like gift recommendations.
So they're using AI to try and boost sales.
It's a high-tech effort to enhance discovery and conversion.
But it's fascinating, isn't it? You have this massive disconnect. You have incredible technological sophistication being used to solve a fundamental affordability problem.
Right. AI is trying to convince a stretched consumer to spend money they might not have, while the underlying economic reality, those structural pressures we just talked about, remain completely unchanged.
Which leads us perfectly to the corporate crossroads, where capital is still flowing, but is flowing extremely fast and very selectively.
That's it. You see this willingness to bet massively on growth in one corner, but at the same time, you see these mounting concerns about liquidity in other, less transparent parts of the system.
Let's start with the absolute epicenter of that growth bet, the NVIDIA AI test. They're reporting fiscal Q3, and it feels like the entire AI complex is trading in anticipation of this one single event.
NVIDIA really is the growth anchor for the whole market right now. The shares have done incredibly well, but because of that, the bar is now just impossibly high.
The market doesn't just want to beat anymore.
No, it no longer accepts just raw revenue growth. It's demanding proof of sustainable enterprise demand and much cleaner visibility into data center spending.
When you say cleaner visibility, what specifically is the market looking for that might be missing right now?
Well, they want to know that this massive demand isn't just a one-time rush from the big hyperscalers like Microsoft or Amazon building out their initial infrastructure.
They want to see the next wave.
They want to see strong adoption from traditional enterprise customers. They want proof the software and services stack is actually monetizing. That's what shows a transition from a capital spending cycle into a long-term recurring revenue cycle. Without that, the risk is just tremendous.
And you can quantify that risk. The options market is implying a swing of up to 7% in either direction after the report.
Which is over $300 billion of market value hanging on the results. It's staggering.
And it reflects a deeper market psychology, right?
It does. A clean beat could stabilize tech leadership. But any hint of softness in workloads, any mixed message on customer spending that could accelerate this rotation we've already seen away from mega-cap tech and trigger much broader market nervousness.
So if NVIDIA represents the high-stakes growth optimism, then the story around Blue Owl represents this growing anxiety over liquidity and valuation in private markets. This is pretty nuanced, so let's break it down.
It is nuanced, but it's so relevant right now. Blue Owl, a huge player in alternative assets, they just shelved a plan to merge one of their non-traded vehicles, OBDC2, into its publicly traded counterpart, OBDC.
And they did this because of investor pushback.
Significant investor resistance and a lot of share price volatility.
Okay, for you listening, what exactly is a BDC, and why was this merger such a lightning rod for these liquidity concerns?
So a BDC is a business development company. You can think of it as a fund that lends money to private middle market companies.
Okay.
The non-traded BDCs, like OBDC2, they're often sold to retail investors looking for high income, but they have very limited liquidity. You might only get a chance to get your money out once a quarter.
I see.
The plan was to roll this illiquid fund into the publicly traded one. But investors in the private fund realized they would lose those contractual quarterly liquidity rights in exchange for the daily whims and risks of the public market.
So the reversal reinstates that quarterly liquidity, which basically confirms just how incredibly sensitive private credit investors are to any changes in their ability to get their money back.
Absolutely. And this is all happening against a backdrop of growing worry about how crowded some of these specialized lending areas have become.
Like AI data center financing.
Especially AI data center financing and just elevated valuations across the whole private credit sector. The Blue Owl situation sends a loud signal that investors are demanding transparency and predictable liquidity, even in an asset class that's designed to be held for a long time.
So the takeaway seems to be that as this sector matures, sponsors have to get much more transparent about incentives and exit options if they want to keep raising capital.
Precisely. If they want to be seen as a mature asset class that can handle real economic stress, that transparency is just non-negotiable anymore.
Okay, and finally, rounding out the corporate landscape, we have the slow, steady regulatory grind of Tesla's autonomous vehicle deployment.
Right. They secured approval for a paid robotaxi service in Arizona, which is a key win. It adds to their operations in Austin and the SF Bay Area.
But there's a catch.
There's always a catch. This is the classic case of the devil being in the details. That Arizona permit, it lets them operate a ride-hailing service, but, and this is the critical part, it still requires a human safety driver behind the wheel.
So fully driverless operations need a whole separate approval.
Entirely separate regulatory approvals.
Which means the operational economics haven't really shifted yet. They're gathering invaluable data, sure, but the cost of that safety driver is still eating into the profit of every single ride.
Correct. The real shift for the balance sheet, the ability to scale and dramatically lower costs, that only happens once they get those fully driverless permits and can achieve much, much higher vehicle utilization.
So it highlights that state-level regulators are really the ones setting the actual pace of AV deployment, no matter how fast the tech advances in the lab.
They're the gatekeepers.
So when we put it all together, the long-term political risk, the fragile consumer, these high-stakes corporate bets, what does it all mean?
It means the market's core attempt to stabilize, which right now is being fueled by this very concentrated optimism for an NVIDIA beat. That attempt is being actively undermined.
Undermined by two formidable structural realities.
Exactly. First, the persistent consumer weakness we see in housing and retail. And second, that growing long-term political risk being embedded at the Federal Reserve, which hits the cost of everything.
Our sources give us a really clear watch list for what's next. We're obviously monitoring the reaction to NVIDIA earnings.
And whether they can prove that sustainable AI demand.
We're watching all Fed commentary for any further signals of political influence. We're tracking the weekly housing and mortgage numbers and, critically, private credit liquidity trends after that Blue Owl event.
And, this source material draws such a clear line between that political influence and the long-term cost of debt and inflation. So if a politically influenced Fed favors short-term growth now, potentially leading to easier money, what does that historical precedent from the Volcker era suggest about the true long-term cost of that policy?
Especially when you consider how vulnerable the dollar's premium is in a world already drowning in debt. It raises a really important question. Think about the cost of that volatility, and we'll catch you on the next deep dive.